It's coming up to 10 years since the financial crisis first started to set in, with lines of people queuing round the block to take their money out of Northern Rock. The ensuing credit crunch and economic downturn. How many times have we heard those phrases over the past decade? Irrevocably changed economies, markets and the world we live in. Understandably, investments of any kind were viewed as a dangerous game back in those uncertain times in the summer and autumn 2007, but had you have been brave enough to do so, where would it have been best to put your money? Analysts at Fidelity International have done the maths and found that high-yield bonds generated the highest cumulative returns over the past decade, with emerging market debt following closely behind. Both edged out U.S. equities, which came in third. Had you have invested £100 in high-yield bonds in August of 2007, that would now be worth £316.68, 216.68%, while £100 invested in emerging market debt would be worth £316.45, 216.45%. A £100 investment in U.S. equities back in 2007 would be worth £309.45, today £209.45%. Commodities would have been the worst option, as a £100 investment would now be worth £89.94. Balanced portfolio essential. The analysis of the returns of the various asset classes over the past 10 years throws up some interesting findings, said Fidelity's investment director for personal investing Tom Stevenson. For example, and somewhat surprisingly, the cumulative returns of high-yield bonds and emerging markets over the past decade have pipped U.S. equities. Bonds have benefited from the collapse in interest rates in the wake of the financial crisis, but without first suffering the savage bear market that equities experienced in 2008 and the start of 2009. Stevenson adds, what jumps out even more for me, however, is the benefit of a balanced portfolio. While there have been some years when every single asset class has risen, and some when there was a mixture of rises and fallers, there hasn't been a single year in which everything has fallen together. This is really good news for a hands-off, long-term investor because it shows that diversification works. Pound set to climb against the dollar. The decline of the pound over the past decade is well known, and it's difficult to remember the glory days, for UK holiday makers at least, when £1 could get you $2 plus a little change. Just before the crisis, the pound was hanging at around $2.05, but then fell down to around $1.60 in the immediate aftermath, which is where it stayed give or take until Brexit. As news filtered through that the UK had voted to leave the European Union, sterling collapsed to $1.30, which is where it finds itself now. Has the rot stopped? Fidelity's Stevenson reckons so, although he's not so convinced about the GBP/EUR exchange rate. Sterling has been on the back foot since the EU referendum, but it has traded in a range between $1.20 and $1.30 for the past 9 months or so, shrugging off a deterioration in economic conditions and intensifying political concerns, Stevenson said. That suggests to me that the bottom may have been reached versus the dollar. Against the euro, things may well get worse before they improve, however. The economic outlook in Europe is better and there is much less political uncertainty.